In a somewhat unexpected move, the Fed opted to raise rates 75 basis points earlier this week, signaling a growing fear of inflation, adherence to market pressure, and somewhat of a disregard for the rising risk of recession. The move wasn't unexpected based on market expectations. Ahead of Wednesday's announcement, a 75 basis point hike was fully priced in, but it was unexpected given the earlier rhetoric from Fed officials, essentially taking a larger 75 basis point hike off the table. Also, while the headline CPI surprised to the upside, there has been noticeable improvement in the PPI as well as the core CPI. The Fed's decision to hike 75 basis points was also somewhat surprising given the increasingly apparent weakness on the consumer front, with some of the largest retailers in the U.S. already reporting that customers are cutting back. And the latest read on retail sales just hours before the June FOMC rate decision showed top-line purchases falling negative for the first time in nearly half a year. The larger 75 basis point increase was also unexpected given the Fed's clear acknowledgement that the vast majority of price pressures are stemming from supply side or because of factors that the Fed admittedly has no control over. Nevertheless, the Fed felt compelled to react with a larger, more aggressive move, given the arguably violent reaction on Wall Street in recent days, with the 10-year yield, for example, rising over 3.4%, the highest in more than a decade, to control inflation expectations and maintain credibility with the markets by signaling a more hawkish tone. In the June statement, the Fed continued to highlight elevated inflation resulting from supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. The labor market, meanwhile, the committee continued to characterize as robust, with economic activity broadly picking up after edging down slightly at the start of the year. Of course, while a sub-4% unemployment rate certainly appears stellar, labor market trends are noticeably shifting as companies prepare for an economic downturn, or at the very least, weakness. Just this week, several large companies, including Coinbase, Redfin, and Spotify, announced sizable layoffs from 6 to 18%. The June FOMC statement also specifically notes the additional pressure to prices resulting from lockdowns in China and Russia's invasion of Ukraine, factors that will not be affected by raising the target on the federal funds rate. At the same time, however, the Fed also added in language this month reaffirming the central bank's focus on taking whatever action is necessary to lower costs, even if such measures prove fruitless against the international variables outlined, and even if by taking such action, a near-term recession is inevitable. Along with the statement, the Fed released updated forecasts for growth and inflation. According to the summary of economic projections, the SEP, despite a faster pace of rate hikes, the Fed remains convinced that a soft-ish landing is still achievable. While lowering the 2022 growth outlook from 2.8 to 1.7% and from 2.2 to 1.7% in 2023, the committee maintains an expectation for positive growth nonetheless. On the inflation front, the Fed increased its outlook markedly for price pressures, at least in terms of near-term headline inflation. The median forecast for headline PCE, the Fed's preferred inflation measure, rose from 4.3 to 5.2% in 2022, but was lowered slightly for 2023 from 2.7 to 2.6. Excluding food and energy costs, the Fed's forecast for core inflation was little changed in June from the earlier March report, revised slightly higher from 4.1 to 4.3 and from 2.6 to 2.7 for 2022 and 2023, respectively. Arguably most important, however, was the upward revision to the Fed's outlook for rates. According to the latest forecast, the committee now anticipates the federal funds rate to rise just shy of 3.5% by the end of the year and rise further nearer 4% in 2023. Previously, policymakers anticipated a rise in the federal funds rate to nearer 2% and 3% in 2022 and 2023, respectively. Bottom line, the Fed has renewed and upped its commitment to reining in inflation, raising rates 75 basis points in June and keeping a second 75 basis point increase in July a possibility, a pathway which will expectedly pose a significant cost to the average American, or more broadly the U.S. economy, but will nonetheless result in a restrained impact in cooling supply-side pressures. Again, raising the cost of capital can drive down consumption and investment, easing demand-side pressures, as we've already seen with a declining pace of sales. But it does little to address supply-side constraints, resulting in the aftermath of COVID-19 or as the result of international conflict. So despite the chairman's declaration Wednesday during the press conference that the Fed is not trying to induce a recession, this accelerated pathway will almost assuredly result in negative growth, best case scenario, or worse, stagflation. In the latter scenario, consumers must still shoulder elevated prices as supply chains remain in disarray and conflict persists overseas. But now, with the Fed hiking rates to a proposed near 4% pace, maybe higher, they must also contend with the effects of a weaker economy. That being said, if the Fed does concede that inflation is largely being driven higher by international or supply-side factors that domestic monetary policy can't control, the question remains, why did the committee opt to raise rates at a larger interval this month? Of course, while monetary policy can address demand-side pressures, as noted, fiscal policy initiatives could provide immediate near-term relief to supply-side pressures. Those in Washington, of course, cannot control the outcome of the Russia-Ukraine conflict or China's zero-COVID policy. However, the Biden administration could, for example, release millions of acres from the Conservation Reserve Program to increase food supply and enact measures often used in emergencies following natural disasters to increase domestic energy production in the short term. And in the long term, the government could promote investment in domestic energy production, including regular and predictable lease sales, as well as streamlined regulatory approval and support for infrastructure such as pipelines, as one refiner wrote in a letter to the president this week. Also, given the cost-push nature of inflation, why is the Fed convinced price pressures will abate back down near the Fed's 2% target range by next year, per the committee's latest forecast? Is the committee assuming that balance is restored to the global marketplace and resolution is reached overseas? If yes, and this is the catalyst to lower inflation, again, why did the committee feel compelled to raise rates at a larger interval? And if the Fed concedes that raising rates at a faster clip will reduce growth markedly, with the Fed slashing their forecast by nearly half and proposing risks to a soft landing, why did the committee risk raising rates at such a large interval? And finally, if the Fed understands that consumers are already facing tremendous, quote, economic hardship because of global events, including $5 a gallon gasoline, and that raising rates simply increases the cost of capital and reduces access to financing for those that need it most to afford gas and groceries, why did the committee need to raise rates even higher? While it will take time for higher borrowing costs to fully filter through the economy, already mortgage rates, for example, have surged. And as the Fed continues to hike, rates will expectedly climb on everything from home purchases to car loans to credit cards. In the end, the June policy decision appears to have left more questions than answers, likely resulting in ongoing uncertainty and volatility in the markets, as well as for the economic outlook.